Excellent, excellent. Well, hello everybody again. And I'm going to ask Haley to just give me a sign that we are live indeed, but I'm going to assume that's the case. We're just in case you were wondering if you were lost. You are now in the panel discussion on carbon markets, operations, functions, and opportunities. So welcome, welcome indeed, and we shall do our best together to live up to the very high standard that we've already seen in the summit over the past day and a half. I wanted to start perhaps by thanking Warren and the organizing team for another stellar conference and summit. It's wonderful to see how this conference series goes from strength to strength. So well done on that. My name and your host for this panel is Duncan Van Bergen. I am a co-founder of Calyx Global. Calyx Global rates carbon credits on their greenhouse gas integrity and on sustainable development goal impact. And we're developing a platform for buyers and users of carbon credits to get confidence about the carbon credits they buy and use. I am joined today by a very esteemed panel. And most of whom don't really need introduction, but I will briefly mention that we should have with us Stephen D'Onofrio from Forest Trends, Alison Graham from Volton Capital, and I have to warn everybody that Alison's internet connection is unfortunately a little bit wobbly, so but we'll do our best and we'll make it work, and we'll make sure that we do get Alison into the conversation. We have Edith Kiss from Mirova, and last but not least, Chris Zink from Conservation International. Each of these wonderful co-panelists is going to do what I'll call a micro introduction when we get to questions in their area. We thought you all would be more interested in the actual debate and in engaging and participating than all of us giving a long speech about ourselves. So we'll all keep it very brief. Now, before we kick off, the organizers, and I have to probably thank with a wink Warren for this, have given us some absolutely key questions in today's carbon markets, which is a bit of a double-edged sword. Yeah, these topics ranging from is there a need to differentiate between removals and reductions? The whole topic of integrity and quality, and also the market depth and interest in what people used to call co-benefits, including biodiversity, other areas of impact beyond climate and CO2 specifically, whether there is market for that and how that would work. These are all, each of them in their own right, worthy of multi-hour, multi-day conversations. And so the risk for a conversation like today is that we get an inch deep and a mile wide. And so between the panelists, we've agreed on one thing. Rather than spending a lot of time trying to define quality, we've accepted a shared definition for today. It's a working definition, and I'm sure there are ways to do this more scientifically and deeper, but quality we've defined as confidence that a carbon credit truly represents what's written on the wrapper. Yeah, the wrapper of a carbon credit says that it's worth 1 metric ton of reduced or removed emissions. And quality, by extension, then also stands for the believability of other claims made by carbon credits, claims with regard to biodiversity or impact on one or more sustainable development goals. So that confidence we have made the cornerstone of our working definition for today, and I'm sure it's an imperfect definition, but our working definition of quality of carbon credits. And so with that somewhat out of the way, we've decided together to dive into a couple of key topics that we thought were germane to the overall set of questions for this panel. And we were going to actually start today with some questions and topics around, hey, how big is the market for quote unquote high quality credits. Yeah, if we say, look, there are such things as high quality credits, is there really a market for it, or are people just interested in the average? And I would love to start with you, Edith, on this topic. And you've got clearly the perspective of an investor with a lot of experience putting money to work in natural climate solutions. And so my question would be the following: as a really experienced investor in NCS or NBS, whatever you want to call it, how are you and how's your team managing the quality dimension as you make investment allocation? Is quality a part of the strategy of the funds you apply? How do you do that? I think people will be interested in how you operationalize that. So yeah, big question to get us going.
Thanks a lot, Duncan, and good afternoon, everybody. Good morning. Pleasure to be here. And I must say that, yeah, the risk of repeating a bit myself from my previous panel this morning, but I think these are very important questions. So I will reiterate some of the points I made earlier. So I work at Mirova. We are an impact investment firm belonging to the French banking group Natixis. And as Duncan already mentioned, we have been investing in natural capital and CS since 2013 through our first flagship fund, our Theta Climate Fund. And I think it's a very important question. I can certainly talk about an impact investor perspective, and hopefully that will answer or shed light a bit on how we view this. But coming into this market early on, actually helping to catalyze the market, because back then in 2013, there wasn't a market yet. Certainly there was already instruments and credits, and methodology was there, and the first forest carbon credit was issued in 2011. Our view was that, as an impact investor, again, we have a holistic approach. And we view carbon as a revenue stream, as part of the investment thesis. So obviously, when you look at carbon just from the sake of carbon, and when we are scaling the market now, we have new players who really need just to optimize their carbon exposure and strategy. That's where you have a risk that you try to get the cheapest carbon possible, and that's where I think we really need those safeguards and minimum criteria. But from an investor perspective, and I think that hopefully can bring some inspiration also to the market and see how you can finance also these projects. When you're an impact investor, and again, as a financier, for us, it's not the main goal is to minimize the cost of carbon or maximize the amount of carbon, is to create impact on the ground. In this case, for example, in a terrestrial case, sustainable, make the transformation for sustainable land use, helping the protected standing forests, and also provide livelihoods and restore degraded land. So it all becomes a coherent story. It starts with the theory of change. You have to define what is your intervention, and in that sense, carbon again becomes a part of your investment thesis. And as I mentioned already earlier today, it's for us really important that carbon is not the end goal. It's your mean to bring in revenues, and over time that revenues translate into the real economy. And then it's not then you have a real long-term impact, then you have permanence, then you have those aspects around the social and look at people, look at the biodiversity. So it's more like, I think, the holistic approach and the impact approach, and not just the tunnel carbon, maximizing carbon, minimizing cost approach.
Yeah, that's super, Edith. And I think for a lot of people in the audience who are possibly just starting as investors or buyers, it, I think, goes to show the amount of work that's required to do this well. I think that's probably something that people will take away. Let me perhaps switch to Stephen. And obviously with Forest Trends and Ecosystem Marketplace, you guys have been what I call the wellspring of market information for many of us who've been in this space for a little while. Do you have data points, Stephen, that you perhaps can share with us from the research and the surveys that you regularly conduct, that can give us some analytical clues about quality-based segmentation? Are the numbers showing that there is awareness of quality, and how are the numbers show that? Do the prices reflect that in some way? I think a lot of people in the audience will be quite interested in that.
Sure. Thanks, Duncan, and apologies, everybody. I'm off camera just for this moment, dealing with some childcare at home issues. But really great to be here today, and agreed with Duncan's opening remarks about the quality of the conference, the summit. A lot of these sessions have been really interesting, and so hopefully this can be a part of that thread. Just quickly though, for us, we're a nonprofit initiative, Ecosystem Marketplace, and we've been doing this tracking of the voluntary market or environmental markets more broadly, covering outside of carbon, voluntary carbon, also compliance carbon markets, as well as water and biodiversity markets. And I think, more to just cut to the point of all this is that our approach is global. So, we have around 200 organizations worldwide that report to us trades, market insights, and other details about their activity and their perspectives on the market. So, this ends up representing around 40 countries in terms of headquarter locations of those organizations, as well as over 80 countries in terms of project location. So, this is a really important question because it's a bit challenging when you look at that global average price, especially for 2021 numbers that we published back in November in time for COP26, where we said, the market has now reached over $1 billion, but that was for around 300 million tons of traded carbon. And that's a really big number. And that covers all these different countries, as I mentioned. So the average prices there do need to be, cut up into slices that allow us to kind of understand the differences of, buyer interest and perspectives based on certain criteria. And we as a kind of an independent and neutral party in this, where we're not making calls about the quality of a certain project or credit or project proponent, what we rest on are the kind of the criteria that are laid out by others. And so what I thought I'd focus on just for this part of the conversation, Duncan, is just to say that we established a partnership with the International Civil Aviation Organization last year, because we felt that even though this was a compliance program for the international aviation sector to reduce emissions and also offset through CORSIA, that the majority of the trading of, and if not all of it, was happening in the voluntary market with CORSIA eligible credits. And so we were already tracking this. And so we decided to put together our own CORSIA price index based on the data that respondents have been reporting. And I bring this up because many buyers that we've heard from are using CORSIA credits or those criteria as a factor for determining quality. If it's good enough for a compliance program, it's good enough for us in the voluntary market. There are other factors, of course. So, but this is just one example. And the pricing that we see on average across some of the major categories: energy efficiency, forestry and land use, renewable energy, waste disposal, the prices for CORSIA eligible credits are higher than the global carbon benchmark from Ecosystem Marketplace. As small as about $1 a ton difference with energy efficiency and fuel switching credits to over $6 or $7 a ton difference for forestry and land use CORSIA credits versus the global benchmark of tons. So I think this is what we are looking to do more of, is if we can understand where the market is consenting around in terms of what is really defining quality. We can slice through the data to pull out information about the methodologies, the vintages, and other details that go beyond project start date, and some of the criteria in CORSIA also have to do with methodology that's being applied, as well as standard. So we can filter this data in various ways. So absolutely, Duncan, I think this is the moment we're in to, not necessarily, just look at the global numbers, and that's useful to some extent. But if we're really trying to, answer some critical questions about, buyer decisions, buyer interests, we need to go more granular than those global numbers.
Yeah, thanks, Stephen. I think what you're telling us that based on some of the correlations that you're able to draw today, CORSIA applicable or CORSIA allowed, and price, that you are starting to see some trends. Obviously, I think there's going to be more information available in the market as it grows. I think the amount of data that's becoming available in this market is going to be very different in 12 months' time than it was than it is today, or definitely than it was a couple of years ago. And I think you get to play an important role in that. I want to do two things. I want to remind everybody that the platform is open for questions, and I'm going to do something. I'm going to loop back briefly to Edith, if I can, because I thought we had an interesting follow-up question from Lorenzo Garofano in terms of asking about, I think picking up on your mention that it was important to look holistically and also long-term at seeing carbon revenue as a starter of an engine towards long-term sustainability. And the question is about alternative revenue streams that you see possibly over time taking over the carbon stream.
Yeah, no, that's a really good question. And so I can give maybe an example how we piloted it or how we see projects. And it depends on and really on the context and the drivers of deforestation. And I will caveat that I'm talking about typically when we're talking about projects, which we think is a very good suitable instrument, because there's a lot of debate about jurisdictional and whatnot. So can go into very quickly in a rabbit hole. But for typically local drivers of deforestation, community driven, where you have a community's livelihoods, slash and burn agriculture, projects we believe are quite suitable, because it addresses on a project is more localized. You can work with the communities. And what we have done, for example, in Peru, in national parks model. So you have a national park that belongs to the government, and then you have communities living in a buffer zone. We have been working with them to address the slash and burn agriculture and provide, for example, agroforestry systems, which take time, which take at least 8-10 years when you plant a cocoa tree before they will start to have revenues. And that's what we done in one instance, where we created a new revenue stream for the local communities, created a cooperative, and these cacao revenues will over time hopefully scale up and have enough revenues for the communities to get alternative livelihoods rather than deforest. In addition to that, it might not be enough, and again, it really always depends on the local context. What we have seen is working is like trust funds, establishment of trust funds, especially that now the prices are becoming more to a level that is meaningful. We started off when in a sub $5 market, $5 market, it was very challenging. As you have better prices, then you can see really creating a kind of a basis, a revolving trust fund, for example, for the parks, that can be a long-term source and then managed, and that also works very nicely with community-based projects or national parks. So those are two examples maybe to answer those questions, but it's a very, very important question.
Okay, that's great. Thanks a lot, Edith. I want to actually bring in another investor perspective in this. Alison, if you can hear us okay. I wanted to bring your perspective as coming from Vulcan Capital, which is a fund that is looking at investing in the voluntary carbon market. How do you, as a new entrant into this space, as a new investor into this space, how are you considering quality as part of the investment strategy? And importantly, how do you think that would work operationally for you guys?
Right. Morning, everyone. Yeah, we've been having some internet instability here, so hopefully you all can hear me. But yeah, in general, so Vulcan comes to the markets from a trading perspective. We're actually interested in project development in some of the frontier countries where we're invested on an equity and debt basis. But if I can continue on with some of the topics that that Stephen had mentioned, because I think the topics of futures markets and in general, kind of new financial entrants to the offset markets that weren't here even 12 months ago is important, and it's having a big impact on quality. So Stephen mentioned the futures markets, and also crypto markets have become large buyers of offsets as well. So I want to stay far away from trying to explain the mechanics of these, but they do have one feature in common, which is that for those markets to work, they have to view commodities as, offsets as a commodity. And by that, I mean that they need to treat offsets in any given category as if they were identical when clearly they're not. So why does this matter? In general, we've started to see some trades in what we call quality arbitrage. And this is something that's not new to the carbon markets. The original quality arbitrage was actually in the compliance markets back when an emitter could purchase up to 10% of offsets to deliver against their compliance obligations. So instead of buying an allowance for, say, 10 or 20 euro, they could buy an offset for €1 and deliver that against their compliance obligations. So that's gone away, but I guess the point of that being that it created a certain amount of demand for low quality offsets. And we tend to talk about demand for high quality offsets, but that was a bit the reverse. There's a sort of a couple of parallels today, which is that once you have a general pool of offsets, they have an average price, and this might be something like the CORSIA eligible offsets that back one of the futures contracts. But any individual trader can kind of take in or put out individual offsets that vary in quality. So we've seen a couple of quality arbitrage trades where in the futures market someone might sell a future, receive the average price, but then deliver against it, say a 2016 vintage. So there's nothing wrong with those. It's more a price issue. But what that's doing is creating a bit more demand for I don't want to call them lower quality, but let's say older or lower priced vintages. In the same way in the token markets, there was a kind of interesting story in January where some savvy traders found an arbitrage with around the Toucan Space carbon tokens, where they were again buying, let's say, older or lower quality offsets, within a given standard, putting them into the pool and then redeeming for higher quality offsets. So anyway, this is just kind of a way in which, a different way of looking at quality from the definition that Duncan proposed at the beginning, and, is having a bit of the reverse effect where, I wouldn't say maybe creating demand for lower quality isn't the right way to put it, but at least supporting, say, older vintages.
Yeah, that's super interesting, Alison, and that's what I'm so happy to have you on the panel, because you bring a perspective to this conversation that definitely 24 or even 12 months ago, this type of liquidity, this type of market action was not there, or at least had been dormant for quite a while at scale. And so this is the reality of how this market is developing, right? It is becoming bigger. There are more participants. There are a lot of initiatives underway to try and improve liquidity. And yet, I think at the same time, you're warning about some of the challenges that's going to pose. And I think that's super interesting. I think there's the perfect segue to perhaps pivot to Chris, here for a moment. And ask you, Chris, because I know Conservation International has been an important participant in the development of the principles for investment in natural climate solutions. And I was wondering whether you could share a perspective on how that initiative and the broader topic of quality of demand has an influence on what you could call more quality conscious demand for credits. I don't know if you can kind of tie those two pieces together for the audience.
Great, thanks for that question, Duncan. Yeah, well, first, like others, I'm thrilled to be able to join this panel and wrestle with and engage with these important issues with all of you. Yeah, just briefly on my background, I've been involved in carbon markets for about 15 years, almost as long as Edit, starting as an originator and deal structurer at a Dutch energy utility. And then for the last 10 years or so, I've been a senior advisor in the Swedish government working on carbon markets, Article 6, climate finance with the Green Climate Fund, always with an eye towards ensuring that Sweden continues to be a leader around strict carbon accounting, transparency, safeguards, and other elements around environmental integrity. Mid last year, I shifted over to Conservation International, really, I think, to in a lot of ways follow my heart into the forest, like I'm sure many of you on this panel and listening to this, you know, that's why we're in this market, in this segment of the market, I would say, right? Because it's so important. I've always felt and that, you know, this is really a key important piece to protect and restore critical ecosystems around the world. And compliance markets like the EU ETS and CDM, they largely stayed away from natural climate solutions. And I chalk that up to really the level of complexity involved. One of my colleagues, Bronson Griscom, who actually coined the term natural climate solutions, he calls it beautiful complexity. And I really like that. It reflects the kind of the reality of the natural world, right? With NCS, natural climate solutions, we aren't talking about just putting a plastic bag over a landfill and flaring the methane. We're talking about working with communities and indigenous peoples to empower them, to provide them with income through the valuation of their ecosystem services, and enable them to support themselves going forward on that basis through the capturing and packaging of the carbon asset, right? So at CI, I manage a fund which invests in and promotes high quality natural climate solutions and seeks to have conversations like this to push the market towards the highest quality types of transactions possible. I'm going to briefly, before answering the question, weigh in on this removals versus reduction debate, because I really can't resist. And then I promise I'll get to the question. For me, it's really clear what we need is both. You've probably heard this, the sort of bathtub metaphor. It's the clearest, I think, as to why. If your bathtub is overflowing, what's the first thing you do? You turn off the tap. Only after you do that does it make sense to reach way down and pull that plug and start removing the water. So any narrative to the contrary does not effectively take into account just how much emissions are still occurring globally and how much reduction actually needs to happen now. If that doesn't convince you, then the cost of removals, both natural and technological, will. Look, we should be doing both right now already, but the whole kind of like debate, which seeks to claim that only removals should be used for offsetting, I think is a complete distraction. So, okay, that one out of the way. I'll finally get to your question on CI's principles for investment in natural climate solutions. And I think this the link to that page on our website is stuck in the show notes somewhere. Let's be honest with ourselves. Carbon markets can be used as a tool either to drive real meaningful change in areas like conservation and clean energy, or it can be used as a tool for greenwashing. It's currently being used for both. Our goal in rolling out these principles was to push the market towards this high integrity direction and really show the way. For that reason, I think these principles are really pioneering because they lay out for the investment community, those of us who are actually engaged in transacting carbon, 3 very clear quality criteria to be met on the supply side and three on the demand side. So on the supply side, I think mostly they don't come as a really big surprise. Projects should be equitably benefiting people and using the CCB standard or equivalent, rigorous third-party verification under VCS or equivalent. I would argue not necessarily a guy in his garage in Mountain View who makes tokens out of thin air. I'm sure there are crypto solutions that are really great, and I need to learn more about that space. So I'm also excited to have our colleague Allison on the line to learn more from her. alignment with host country policies and carbon accounting. This is even more important now that we have the Article 6 rulebook from Glasgow, and we have to respect the wishes of host countries. But then we get to the demand side, and it really is a quality continuum. You don't just have to focus on the supply side quality. If you don't have quality of demand, the transaction lacks integrity. So this is about who can justifiably participate in carbon markets and the purchase of offsets without making the whole thing look like a big greenwash. So companies who buy credits must be on a path to net zero by 2050 with real achievable interim targets, halving emissions by 2030, and then they need to fully disclose their emissions. They can use credits as offsets, but only if they keep cutting their own actual emissions. So the use of offsets should not delay progress towards companies' own internal emissions cuts, only for those hard to abate emissions. CI has taken a further step to say that we won't partner with or transact with companies whose majority business is related to fossil fuels. And there's a lot of reasons for this. But here, for that kind of piece of the conversation, I'll actually take off my CI hat and share a few thoughts on fossil fuel companies and their participation in voluntary markets. Not everyone is likely to agree with me on all of these, and that's perfectly fine. We'll see if I get invited back to speak again. But plainly, the oil and gas sector, which I should say has many wonderful individuals working within it, many of which are my friends, but the sector as a whole is not only historically culpable for the current climate crisis, as we know, but continues to increase exploration and extraction and building of new high-emitting energy infrastructure, in stark contrast to the sharp increase in climate and net zero rhetoric that comes out of the same companies. And of course, you don't have to take my word for it. There's new publications that are coming out all the time, for example, from the New Climate Institute and Plus One, which show very clearly the increased usage of rhetoric around net zero and sort of ESG, while investments into high emitting projects continue along in business as usual. So it's important here for me to add that I'm not speaking to the small conservation project developers and proponents right now. If you're a small organization and you have a forest protection or restoration project that you want to get funded, it's a completely logical argument to say, look, my priority is funding this activity, and I don't have the luxury of deciding where that money comes from. So when I make these remarks, they're really meant to be at the 30,000 foot level. How do we as market participants ensure that the entire experiment of the voluntary carbon market isn't perceived by non-experts as an illegitimate greenwash? And there's new articles all the time that basically accuse the entire market as being illegitimate, and that's what I'm seeking to address. So I'm closing soon, Duncan. I would argue that the goal of the voluntary carbon markets, and anyone who's looking to work or engage in the voluntary carbon markets should really have the goal of putting themselves out of a job over the coming decades. That should be our goal. These markets are not the end game. They were initially meant to be a kind of gateway drug for compliance markets, but they're an incredible tool, and we should absolutely be using this tool for good. But we all need to kind of work together to ensure that this interim fix is not misused by companies and sectors that don't really have any intention of changing course. I would say that actions speak a lot louder than words. So we have a tremendous opportunity now to utilize financial flows, as kind of Edit was saying earlier, based on net zero commitments to finance critical forest protection and restoration. And the key bit here is that maintaining trust and legitimacy in the market will allow that to happen. Will allow for that finance to continue to flow, and we need to respect some guardrails. So thanks for indulging my slightly long intervention.
No, that's all right, Chris. It's, you made some strong points and made them eloquently. You touched on a whole smorgasbord of items, including at the end this quality of demand, integrity of demand topic, which I think is indeed a super important one. I want to pick up on something you said earlier on, which is on the removal and reduction, and I applaud you for making such a strong statement, which I'm sure different people have different views on, but I wanted to piggyback on that and get back to Stephen for a moment. Stephen, you mentioned it earlier, and we all know 2021 was somewhat of a breakthrough year for the voluntary carbon market. are you seeing in the data evidence in this removal reduction conversation that definitely I noted that in 2021 that became a higher volume conversation than it had been in the years before, at least as far as I was aware of it. Are you seeing that? What's the data telling us? Are there other trends? Is there such a thing as fashion in the market? People liking this more than that? Yeah, what are you seeing? Stephen, if you're with us, you're on mute. And if you're
Okay, I may need to come back to you. Just give
Okay.
about a couple minutes. I'll give you a prompt. Sorry about that.
No
Thanks.
worries at all. I wanted to perhaps pick up one of the questions, two of the questions from the audience, and I'm going to open it up to any of my co-panelists. They're both with regard to the supply of capital into the market. One from Lorenzo Garofano is around pay. What do we see as preventing more capital, more private capital flowing into NCS markets? And then somewhat related, Robert Wust asked earlier what we thought main obstacles to launching agroforestry projects were. And so I don't know if one or more of you wanted to comment on those.
Sure, I'm happy to, if you.
Thanks, Edith. Yeah, please go for it.
On the NCS, on the capital flows, I think the good news is, as we have already discussed, the prices have increased and there is some more liquidity and visibility on the forward curve. So I think clearly when we talk about the business case or it's there for that type of projects where you have a carbon case, a robust baseline, and there are the issues still more around where the current methodologies do not allow generating carbon credits, for example, HFLD, so high forest, low deforestation countries, or where you have, where you're not able to, for certain eligibility criteria, generate enough carbon. So there we need to be still more creative and multiple revenue stream and more complex approaches. And on the projects where you have a clear carbon play, let's say, or carbon potential, I think at the moment we are at a very interesting junction because there is a lot of capital trying to flow in, and we do have some bottlenecks. And I think that's why we need to be also careful, because it takes time to develop high quality projects, and we need to avoid people becoming a hype and selling projects on paper, right? So you need a thorough. It's a cyclical one. We have been sitting on a big oversupply for years, and now as I think the bottleneck is on the capacity on the ground. We need capacity of the government side as well, also around these new rules to understand how you approve these projects, but also on the implementation side, consultation with the communities and all that takes time. So we need to be patient, and we need to ensure that there is enough time allowed for this quality, all these factors to be factored in, as we discussed in the beginning. These are very complex projects. They are often, we call them social projects. They have social components. So you shouldn't rush to just create and maximize carbon. And I think that's where we are a bit, and the skilled expertise. We need to bring in more people into the market, and it's very difficult because of the lack of the skilled people in this sector.
Thanks a lot, Edith. That makes a lot of sense. Hey, I'm going to attempt something dangerous here in the last 5 minutes and open up another topic for conversation. And I wanted to perhaps turn to Alison briefly for a perspective on the market interest in attributes other than the climate attribute, the CO2 mitigation attribute of carbon credits, either as co-benefits or as SDG impact claims associated with carbon projects, or as separate instruments. What's your read in terms of there being an appetite for this?
Yeah, well, I think if I can take an example again from the equity markets, I think there's a correct middle ground in the sense that, equity markets will always impose a discount on conglomerates, in that if you put too many things into the same bucket or the same instrument, it becomes hard to actually visualize and value all the individual pieces. But on the other hand, if you try to, split out kind of every possible co-benefit into its own instrument, you'll get a market that's very thin and illiquid. And again, it's another way of not getting the proper value for those components. So the question is, what is the correct middle ground? And my short answer in general would be, yes to a biodiversity credit and no to almost everything else. And I say almost everything because, again, if I can go back to the futures market for a minute, there's another development going on there that I think is going to affect, how many and which of the co-benefits actually get spun out into kind of, if not separate instruments, at least something that's separately highly visible to offset buyers. And that's today, a lot of, under one of the contracts at least, the offsets that one can deliver against a futures contract have to have at least one CCB element attached. But they now or soon will be able to have up to 3 elements attached. So there's a reason the market operators are doing that. And it goes back to this question of the commoditization of offsets, which is they're viewing kind of development of offsets in the same way that you would view development of the oil market, meaning that in oil, you have kind of Brent or WTI as a benchmark standard, but one can trade oil of different qualities and it's priced against that benchmark. So you'll get a premium or a discount to WTI or Brent. The operators want to see the same thing happen in carbon, where there's, say, a benchmark carbon price, and it would probably be the CORSIA eligible pool of offsets. But they do want to allow kind of a finer segmentation of quality in the market, where you could price an offset that has say 1, 2, or 3 CCB elements against that benchmark. So what this means to me is that we can talk a lot amongst ourselves about, should it be biodiversity, should it be clean water? In general, I think that things that are easy to measure and easy to conceptualize, like clean water, sanitation, biodiversity, will take the forefront, where something like justice or equality that's a lot harder to measure will not be spun off into separate units. But it could possibly be that the futures market, decides that for us in terms of, being the place where there's lots of capital trading now, and they're going to pick out what they choose to place a value on. So let me stop there for the moment.
Hey, thanks again. Really happy that you're in this conversation. I wanted to perhaps pivot back to Stephen with 2 questions. The one that we were asking or talking about earlier, what you are seeing in terms of trends in the market, removals, reductions, other fashions or demand trends and evolutions that you're seeing, but perhaps starting with this latest topic that we were trying to unpeel a little bit in terms of interest for the non-carbon attributes of carbon credits, either as part of carbon credits or as separate instruments.
Yeah, sure. Thanks, Duncan, and apologies for that delay on my side. Yeah, I think just like in any market, there's a little bit of a time delay between debate or noise you hear in media or from a loud vocal few about something as like reductions versus removals, and if it's removals, should it be industrial or nature based? It's just like anything else. We have to be patient to see how that moves from talk into actual action. So we haven't seen that yet, and I think a large part of that is due to the fact that the industrial removal side of this equation is a longer term play. There's more investment into technology and to actually make these projects cost effective and scalable. Whereas nature is cost effective and scalable today. And that's I think the examples we're hearing from the 2 panelists from Mirova and CI, who are respondents to our survey as part of the global network. And I think what's important here is is that when we look at just the 2021 data that we published back in September, we're in the process of truing that up, and we'll have updated, hopefully final 2021 numbers at the end of March or early April. That the forestry and land use category was really the one that jumped the most. In fact, just comparing to 2020. So, you know, we went from around 48 million tons of transacted volume in 2020. Year to date through August of 2021, that had gone up more than twofold to 115 million tons. Whereas renewable energy stayed at about the same level as 2020 numbers at around 80 million tons, and so did the rest of these, you know, major categories. So they've all seemed to be increasing or you know, upticking, but forestry and land use clearly, you know, coming out, you know, far above the others. And I don't know if we, you know, necessarily see that as slowing down, especially in the near term. You know, I think the dynamics at play though are things that Edith mentioned, which is the, you know, if we are tapping into the current supply, if that supply is being sold not just to end buyers but into the middle of the market, and then calling for higher prices, then, you know, what is the willingness of buyers to pay for credits at different price points? And that then leads into, you know, exactly what you're talking about here of how these additional attributes of co-benefits of biodiversity, indigenous people safeguards, and other, you know, values for ecosystem services that, you know, do factor in very much so. And we see this when we look at the prices of like a carbon standard benchmark, you know, Verra, Gold Standard, others. And then when they add in additional certifications, whether that's things like SD Vista or CCB, as well as, you know, certifications like Forest Stewardship Council and others, that these prices, you know, do consistently, you know, show higher value. And that means that these elements are embedded into the credit. They're not necessarily considered separate indigenous peoples credits or biodiversity credits, which there was a panel yesterday that we talked about this, but I think the opportunity here is to, you know, really pull apart and value these different elements, you know, in a way where maybe they're not separate as credits, but they can be quantified to show that you get a 20% arbitrary number, but a 20% premium if you do have a certification standard for sustainable development goals applied, you know, to your project. So this is happening. This is very real. I don't necessarily think we're in the debate of, well, should it be a reduction or removal, and if it's a removal, should it be nature-based or industrial? I think we need all of these options at the fingertips, and buyers will choose, you know, what their interests are, and we're seeing that very clearly. You know, there's no shying away from renewable energy just because it you know, solely gets to the carbon elements, and it does have social benefits as well. But, you know, the dynamics of a REDD+ project are greater in terms of those additional attributes, and buyers will lean towards that if they're also trying to achieve sustainable development goals or other you know, more sustainability related indicators for their business. So back to you, Duncan.
No, thanks a lot, Stephen. The history is still being written. I can tell. The numbers show certain trends and show value for additional benefits, but you haven't yet seen that much come through in the numbers in terms of segmentation based on removal and or other attributes. It'd be interesting to see how that evolves over the years, and also given the volume of talk there is, at least on this topic. I've noticed. I don't know, Edith, if you wanted to weigh in on this topic at all. And if not, we were happy to take some audience questions.
Yeah, no, I think this is a very interesting topic, and certainly something we have been looking at again at the impact from an impact investing perspective. And I agree that I think the next logical step is to start quantify and verify better the biodiversity impacts. Questions around additionality. If you just happen to be in a biodiversity hotspot and happen to, you know, you do whatever you do for your carbon, and that happens to have some impact on biodiversity, that's okay, but it's not maybe enough. And I think where is it getting interesting is where you can start looking at what can you do on top of that, and looking at the pressure on the biodiversity, for example, if you have hunting pressure or something additional, that's definitely then merits additional funding. So I think that's where it's interesting to look at all the work around the new metrics. For example, the IUCN STAR tool, which is for the first time ever, looking at, based on the IUCN Red List species, this kind of more intentional activities. And if you have that aspect, rather than just saying, okay, this is the amount of hectares, I happen to have some camera traps and some animals happening there. So we'll need to move, I think, again, the additionality will be key for these new kind of environmental assets or biodiversity assets to be created. And then the only way to, you can only detach and monetize them separately if you have a clear additionality argument. And then where I think even more excited beyond where we talk about beyond carbon is where, again, you have landscapes where carbon is not working because of the methodology, because of the eligibility criteria, but they are biodiversity hotspots. And there, these type of new kind of assets can play the same catalytic role as carbon played on those forests where you had the carbon. So I think that's the next evolution we're looking at, piloting in our portfolio and looking at these new metrics, how we can apply and bring some data from investments to the market.
That's great. Maybe just a quick follow-up. Is there investor interest in terms of people want you to deploy money in these new separate assets?
So that's what we're looking at. It's the business case is, as I mentioned, a business case is not there yet for these ones. We need to take the same kind of leap of hope that we did in 2013 on carbon. So what we're looking at is to combine with real assets or a proper real asset investments. Like we're looking at a conservation enterprise based on NTFPs, for example, and it's very difficult. So that's where you need much more still co-building of the business case, where what I mentioned with carbon, the business case is there, it's more the lack of the bottlenecks on the ground, right? So we need all, and again, we need holistic approaches and solutions for different, all the different landscapes and ecosystem services.
That's that's encouraging news. Hey, Chris, I wanted to bring you in again and ask you the question coming from the civil society angle in terms of, okay, well, what can we do and what is civil society doing to make sure that this rapid growth of demand we're seeing in carbon markets does go hand in hand with impact? Well, first of all, with a do no harm guarantee in terms of how it impacts society beyond this carbon element, but preferably in terms of having actually a net positive impact on a number of other criteria, both for planet and for the planet and for people.
Great, thanks for that. Yeah, I think what I found that one of the most exciting things about being at an organization like CI is that we can wear so many different hats. We can develop projects from the concept stage onwards. We can finance activities with a blend of kind of concessional donor finance, public finance, which we manage, and private finance via corporate partners that want to transact these high quality credits. And we have a marketing sales team to do the kind of downstream transactions. We have a science and strategy team, community and safeguards. So we're all kind of thinking through these elements together, and I think that's a cool part of it, that we're kind of all working towards the same goal, contributing with kind of our each niche expertise. So the role, I think, of civil society and NGOs like CI and others is ideally to kind of to drive this rapid change that we need, but also, and kind of that was part of what I was doing earlier, making us stop and reflect on the decisions that we make as we march forward on this path. So I think that's kind of our role, and it's a balancing act, right? We know that we need to move fast, and I think it's really exciting to see how fast the market is growing. But at the same time, with such speed does come potential pitfalls, right? We need to ensure that projects are well designed, using the best science, and that the people and communities that live in and around the natural landscapes that we're protecting, restoring, managing, that their rights are respected, and that they're trained on what it means to reduce a ton of carbon, package that and sell that as a commodity. It's not immediately intuitive, I think, to anyone, and it takes time and patience and expertise to do these kinds of trainings, stakeholder consultations. So my plea would be, engage with local experts, with local partners, so that we can get this mitigation done as quickly as possible, but also as intentionally as possible.
Okay, this is fantastic. There's a bunch of super interesting questions still that we didn't have time to get into, but I'm very conscious that we're heading towards the hard stop, and I don't want us to stop mid-sentence. I'm just gonna start wrapping us up here, and first of all, thank my co-panelists. This has been a high quality conversation. Nice to use the quality term in that context. I'm grateful for the opinions you guys have shared. I can definitely tell, based on the types of questions and answers that we're getting, that this market is maturing quite quickly. The degree of crystallization that is starting to be applied in terms of understanding, well, first of all, in terms of debating these topics around quality and demand, and what is in demand, what is less in demand, but also the data that's being applied to these debates, and also the market instruments and the infrastructure that exists and the types of transactions, types of players that are emerging is just evolving so quickly. This is not yesteryear's market anymore, and I suspect that if we were to all make a date to reconvene in 12 months' time, the market would be very different again, and there probably would be some crypto people in the conversation, Chris. So you better spend some time in Mountain View and figure out how the whole thing works. But I think that's a sign of a market that's evolving. I think if we all make an effort to make sure that quality and integrity remain key elements on our compass, then I think there's an opportunity to do some real positive impact. Thank you so much. Thanks again to the organizers for having us today. It's been a real privilege. Thanks to the audience for your great questions, and hope to talk to people in this forum or elsewhere.
Thank you.